The full description of Social Security benefits is OASDI, which is Old Age, Survivor, and Disability Income, or insurance. So those are the three phases where you might receive Social Security benefits are old age or retirement, survivor, where someone in your family has died and you're going to get Social Security benefits based on that, and disability insurance, which is if you become disabled during your working years, you can start collecting Social Security benefits. Certain government retirees do not contribute, or certain government workers do not contribute to Social Security, and they won't get Social Security benefits. If you have a mix of work that's covered by Social Security and work that's not covered by Social Security, then your Social Security benefits will be reduced by something called the windfall elimination provision. Okay, so the way Social Security works is as you're working, you're paying into the Social Security system. And that money is not yours. It's not set aside. It's not counted as your money. That money is paid out at the same time to those people who are collecting Social Security. So for most of the history of Social Security, there's been a surplus. More money is being paid into Social Security than taken out. And that is probably not going to be the case much longer. But the excess Social Security benefits that are being paid in are paid into a trust fund, which invests in government bonds mostly, which is the U.S. government borrowing money from that. But as long as there's a surplus in Social Security, the current formula will probably stay the same. You may hear, especially in election years, you may hear about the Social Security Trust Fund running out. But even if it runs out, the current people paying into Social Security will still be funding those who are being paid out by Social Security. So it's not like you're going to completely have no Social Security benefits as long as there are workers younger than you or still working that are paying into Social Security. So Social Security taxes that are collected are being paid out to the current retirees. What they do keep track of is what your annual wages are, and those are re-indexed for inflation. So if you made $20,000 in the 80s, that's going to be about the same as making $50,000 now, or however that inflation adjustment works. So it's, and then your benefit is going to be based on, they're going to take the top 35 years on this adjusted indexed monthly earnings, top 35 years, and average those out. And they're going to base your Social Security benefits on how much you earned in the top 35 years. So if you work for less than 35 years, they're going to pad that out with zeros to make your average lower. So if you only work for 20 years out of your life and you made, let's average it out to 100,000. So if you work 20 years of your life and made 100,000 every year, here's my calculator. 20 times 100,000, and then you have, but then you'll have 15 years of nothing. So when we divide that out by their 35 best years, it's going to be as if you had made $57,000 a year for all 35 years.
And then you only get a percentage of that.
Right. Yeah, and there's it's a actually regressive formula. Like when we talk about tax system, we call it progressive, which means as you earn more, the higher tax rate you're in. So Social Security system or the Social Security benefit is technically regressive, which means the more your average monthly earnings were in your working years, the smaller percentage-wise your benefit is. And I forget exactly what the formula is, but it's something like 75% of your first 10,000, and then it goes down to way down to 40% of your next 50,000, and then it bends down to another 20% of anything above that.
Why? What is happening to Social Security? Why is this amazing?
It won't. Yeah. If the Social Security Trust Fund runs out of money, then have to um, they'll have to pay benefits, but they'll have to pay out only as much as they collect in the same year. So they may have to refigure the formulas in that case.
Okay.
There was a study done back in the 80s to determine how much benefits people were receiving from Social Security compared to how much they paid in. And the study broke the population up into segments of like single people without children, married people with and without children, or single people with and without children. And they found out that for the people who got the least benefit, which would be single people without children, they still got about 6 times as much as they put in. And that's not corrected for inflation, that's just on a nominal dollar basis. So if you paid over your lifetime $100,000 in Social Security taxes, you expect to collect in your old age about $600,000 on average. That's for that whole segment. Like, of course, if you die early, you collect less, and if you live for an extremely long time, you end up collecting more. But that is where we get, when we talk about taxable Social Security, that's where we're going to get that an 85%. We also get a 50% Social Security being taxable because even though you have Social Security taxes taken out of your paycheck, and you don't get a deduction for that. So that's after-tax money. Your employer also pays pays the same amount of Social Security tax, but you don't pay taxes on that. So half of your Social Security benefits are coming from money that you paid taxes on, and half of your Social Security benefits are coming from money you haven't paid taxes on. So it makes sense in a matter of thinking that half of your Social Security benefits ought to be taxable. And then in a different way of thinking, like if you're going to get $1 for every 15 cents you put in, which is how that study came out, then it also makes sense in a way of thinking that 85% of your Social Security benefits are taxable. So they, based on that study, in the Tax Reform Act of 1986, Congress decided that up to half of your Social Security benefits should be taxable income. And then, and that the taxes on Social Security benefits actually go right back into the trust fund. So that helps shore that up. So back in the early 80s, when people were saying the trust fund is running out, they said, well, why don't we tax some of the people who receive Social Security benefits? Like, if you get a retirement fund, if you get a pension from your employer, that's all taxable. So if you're getting a pension, basically Social Security pension, if you're relying on that for your income, you're actually in an advantageous position compared to people who had traditional employer-sponsored pensions, because if your Social Security is not taxable, then you get to keep all of your retirement income, whereas people who have pensions, they have to pay taxes on their pensions. So that kind of leveled the playing field between people who are getting pensions and Social Security and people who are just relying on only Social Security. Then in the 90s, I want to say it was 94, they, based on that same study, they decided that up to 85% of your Social Security income could be taxable, because really only 15% of the benefits you get back reflect your original investment in Social Security.